All right, let's go ahead and get started. I hope everyone can still hear me okay. My name is Hunter Smith with MetaStock, and I'm excited to bring this webinar to you today. Thank you for coming to Mr. Michael Dillon's Discover How the Dillon Support and Resistant Prices Can Improve Your Trading. We're very, very excited about this webinar. If you've if you've listened to one of our webinars before, you'll know that we have to get the disclaimer out of the way. This demonstration is designed to instruct you on using MetaStock and accompanying software plugins, and it's not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. Now, we are very, very lucky to have Mr. Michael Dillon here today. A little bit about him: he actually started analyzing commodity charts in 1980, and a few years later he started to analyze the currency and the stock markets as well. He's actually published market newsletters, given many, many seminars all over the world, including for us, and we're very excited to have him, for the webinar. Now, he is also the person who discovered the Dillion Wave Theory, which we fully believe is sure to become a classic in technical analysis and market analysis overall. So without further ado, I'm going to turn the time over to Mr. Dillon, and if you guys have any questions, feel free to put them in the chat box.
So this webinar is about analyzing the markets using swings and relationship of swing prices, and the strengths of this method is not lagging. It's a predictive tool. It's highly accurate. You can place your stops and entry points and profit targets in advance. It brings a new level of understanding to chart analysis. That's the most important part of it. It brings a new clarity, new depth to understanding what charts are telling us. It organizes price swings in an objective manner, helps you trade with the trend. Like any tool, it's not 100% accurate. There can be a learning curve. You can trade it for stocks, currencies, futures, position trading, swing trading, and day trading. The focus of Dillion Wave Theory is on correction swings. There's small correction swings, the big correction swings, and we'll get into in-depth analysis of that in a moment here. So let's look at the daily chart. This is a recent daily chart of SPY, where about 100 million shares are traded each day, and it mimics the S&P 500. It's an ETF. So when we look at a chart, the reason we look at a chart is to get an understanding of what's happening, what we should do. So here we have like a big drop, and the question becomes what to do. Is this a trend reversal? Is this a big correction? What should we do? And if we use tools like the stochastics or other indicators, they're lagging. For example, here, I don't know if you guys can see my cursor right here at the bottom of stochastics. The entry is over here, which is really lagging. You'll see in a moment how Dillion Wave Theory entered right down here. So quite a bit different. Same thing when you come down here. By the time you get a buy signal lagging, or it's early, it's here, whereas Dillion Wave Theory gave another buy signal at the bottom here. So to get a better perspective, I'm going to delete this indicator. We don't need it anymore. Okay, so we're going to go to weekly charts to get a bigger perspective of what's happening. So here what we have is a correction back in 2011. This is the biggest correction. This is where the downtrend ended, and we began the uptrend. And here we have this big correction. What the Dillion Wave Theory says that market develops its price swings in sets of two corrections often enough that you can actually use it to make money and organize the charts. So what we do here is, this is the quick method of analyzing the market using the Dillion Wave Theory. These rectangular boxes are available just about in any platform. So here we measure from this high to low. When the market makes a new high here, what we're going to do is we're going to move this box up each week. These are weekly charts. Each bar is a weekly chart. And eventually the market should come down to the bottom of this correction where the support price is and rally from it. It might, for a big correction like this, which was about 19%, it's going to take several months to a few years by the time that occurs. But it gives you an idea. So here is so each week as the market makes new highs, you move the box up all the way to the highest high. And then you can see the support price was at 184.03, and the market came down to about 182. So that's how the Dillion Wave Theory works. So we're going to get into in-depth and details of it because there's a lot to learn. But you can see from confusion of what should I do, you end up knowing ahead of time that the market was very likely to match this big correction over here. Let me highlight it. This big correction here, you were expecting to drop again that much over here. So knowing that, you didn't get confused. Instead, you saw this as an opportunity to buy near the lows here. Now, when the market goes up this much, it actually completes the rhythm. I call these cycles rhythms. There's these big rhythms, like over here. There are these smaller rhythms. There are these even smaller rhythms inside the rhythms. So we're going to analyze and look at all of the rules that go with these tools. So the second time the market comes down, it's not as guaranteed that the support price is going to hold. So I tend to wait and look at the intraday bar charts, trying to figure out if there's going to be a buy signal. One good thing is often the markets develop in an A, B, C swings. And if the C swing is lower than the A swing, that's also a good way to get in because it's near the support price. So, okay. So what we have is, let's look at the entire cycle here, all of the different rhythms, going back to the beginning where the downtrend ended here and the uptrend began. For the beginners, I want to do a quick educational here. The waves that go with the trend are called trend waves, and the corrections that are against the overall trend are called correction waves. And then you have trend wave again. The markets always end the downtrend with a trend wave and always start with a trend wave. So you have your trend wave, correction wave, trend wave, correction wave, trend wave, correction wave, trend wave. So this is important to understand. So here the trend is starting to go up. Right here on my left side, if you can follow this yellow highlighter. So we have this correction here, and the market rallies, and the Dillion Wave Theory says there should be a similar size correction. Similar size means, let's say this was 100 points, maybe it will be 99 points, maybe it will be 101 points, it might be 115 points, it might be 85 points. Similar is about within 20% of each other is what similar means. You cannot match this small correction with this big correction because it's not similar in size. Nor can you match this correction here with this correction here in the future because they're not similar in size. They're very different. It's two different rhythms. Each rhythm has its own set of trend waves and correction waves. So let me erase these quickly. So what we do is, this is the, let me get my cursor back here. All right. So what we do is, this is the quick way of analyzing the markets using the Dillion Wave Theory. Come down, grab a rectangle, measure the wave, size of the wave. As the market moves up, move it. Eventually, if it comes down to the bottom of the correction here, this is your support price right here. So you would jump in. So what you will do is, you see that the market is coming down, put your limit order in ahead of time, because markets sometimes will drop sharply, as it did over here on your right side, when the market dropped here really fast and then rallied the same week very high up. So you didn't want to miss this. So as the market comes down, put your limit order in, put your stop in, put your profit target in, and it's all going to take care of itself if you put your stop and profit targets in. With these predictive trading, always make sure you put your stops in ahead of time, because market could just go right through the support price and drop really fast. At the same time, you want to put your limit order in, not to miss these best trades where the market drops to support price and rallies. So what you have is, you have this rhythm completed. So you have your trend wave, correction, trend wave, correction, trend wave. That cycle, that rhythm is completed. Now you have a bigger rhythm here. So we're going to measure that really quickly. And here it is. And as the market makes new highs, that's the key. The market has to make new high. It has to go above the previous beginning of the correction wave. This was where the correction wave began. It dropped down to here. So we need to see new highs. Once there's new highs, start moving the support measuring tool. That's what we should call it, a support measuring tool. And here you have it. So you have the Dillion Wave support price right here. Market went somewhat below that. That's why you want to use stops a little bit at a distance. It made it rally, and then it came back down. Now, this correction here, let me grab my tool so I highlight it. This correction here, when it was up to here, it was within 20%. But once it dropped down to here, that's bigger than 20%. Therefore, this is a new rhythm. Okay, so what we're going to do is, we're going to take, go back to the cursor. What we're going to do is, we're going to take this box and expand it. There you go. I'm going to make this a little wider now that we know what happened in the past. So we have the support price here. Now, if you want to measure this actual, this is the high, 137.18. This is the low, 107.43. So you would subtract that, and you come out with 29.75. This is the size of the correction. As the market makes new highs, you would subtract 29.75 from the highest high, and you would end up with 184.03 as the support price. As I said earlier, market dropped down to 182 and then rallied. So as the market is developing, now we are back into the trend wave. Here's another correction. Now these are weekly charts, so these corrections are fairly big. So what we're going to do is, we're going to take another rectangle, measure this. Let's make it a little bit more exact. And then change the color of it. So it's, I identified different rhythms with different color boxes. So when the market makes a new high, goes above this, okay, this rhythm here, you need it to go above the correction wave. Now this is a new rhythm, and it has to go above its correction wave. In other words, where it began before. So when this market makes a new high here, we're going to move the box up each week. And when the market goes above this high here, we're going to start moving this box here. So now we have two rhythms simultaneously developing, and it's giving us two opportunities to buy at the Dillion Wave support price. So as we move up, the market starts to move down, and here's the support price, so you would buy. And then it's up to you to decide whether you're going to go for a 5 ATR profit target or 1 ATR profit target. If you think it's the very beginning of the uptrend, you can stay in for quite a while. It just depends if you're a position trader, a swing trader, or a day trader. So this cycle here is completed now because the market came down to it and it rallied. So you have your first correction, you have your second correction, and you have your third trend wave. This blue cycle, however, is not completed, so we're going to keep moving up. Now, interestingly, the cycles can have as many as 6 corrections in them. 6 corrections of similar size. You can see this was the first correction, which we took as the beginning of the rhythm. This was the second correction. This is the third correction. Now, there are certain rules I use to enter the third correction because it's not as accurate as the second correction. In other words, the first time the rhythm is matched, it's highly accurate, and I want to jump right in. The third time, it becomes less accurate, and the fourth time that you have the rhythm repeat, it becomes even less accurate, and I almost never trade that, unless I go to daily bar charts and I get a triple bottom, and then I can use that. And then the cycle repeated one more time. This is within 20%, so I consider this to be part of that cycle. So we have 1, 2, 3, 4, 5 corrections. I'm going to pull up my highlighter tool just to emphasize. So you have trend wave 1, correction 1. Trend wave 2, correction 2. Trend wave 3, correction 3. Trend wave 4, correction 4. Trend wave 5, correction 5. And then we are into trend wave 6, which then ends up with a bigger rhythm. Now, let's see. So now what happens is you want to start with the biggest perspective. This is why you want to use weekly and monthly charts. If you're looking at this whole picture on daily charts, you wouldn't be able to see much. Just like when we first started, when we looked at this scenario on daily charts, it didn't make much sense. But when we went back and looked at the entire history, because Dillion Wave Theory has to do with relationship of swings, so you need to go all the way back to the beginning of the trend and see what has happened to organize the charts in an orderly fashion and make sense of them. And then you find these support prices. Now, this big correction is in a huge uptrend. But within that, you're going to have the smaller cycles. So here you have, as an example, a smaller cycle. These are the smaller rhythms. And inside that, you're going to have even smaller rhythms, which means you need to go back to your rectangle here, grab it, measure this. Of course, for these smaller corrections, you want to drop to the daily bar level, and then that correction matched here, so you had your buy signal here. So at one point, you had 3 cycles going on at the same time. We can come back to all the way down to this here, measure this cycle. So now you have this big rhythm, you have this smaller rhythm, and you have the smallest rhythm, all 3. And you keep moving your boxes up, and this rhythm came close enough to get in. This is the other thing. I don't wait for the support price to be exactly to be reached, because the best trades fall a little short of the support price and rally. So I always get in a little early to make sure I catch these. And then after completing this cycle, this rhythm, the market comes back down and matches this rhythm here. And then inside this trend wave, you're going to have these smaller corrections which match. And then inside this trend wave, you're going to have smaller rhythms matching as well. And then here's another one. Inside this bigger rhythm, this trend wave, now you have this rhythm here, and it's matched here, so you would have bought it at the bottom here. So let's look at the daily charts to have a little different focus. Okay, I'm going to erase these drawing tools. There we go. So now we're going back to, let's see. This is the big correction. Recently we matched. By the way, by knowing that this was the second correction of similar size, now we know that we are in trend wave 5. In other words, I mean trend wave 3. Or fifth wave of the cycle, of the rhythm. So that means it's very likely we're going to have new highs made and that the bull trend is going to continue. And it gave us two opportunities to get in, over here and over here. Remember what I said, when the market bounces off of the support price for the first time, it's very accurate. Second time, you want to wait to get some kind of a confirmation. A good confirmation is here. It made a new low, and then it had a strong close right here, the closing price. You can use like a candlestick bar chart to give you an idea. And the other indication that this market was still strong, it made a double bottom here, and then it broke out on the upside. And that would be another entry point using the second time the market comes down to the support price. So now I want to go back to where we started from. So here's the big correction. Here are those smaller swings, which look small on the weekly chart, but it's actually fairly big on the... And then here's the other rhythm. So we're going to make a rectangle for that. Like I said, you can actually calculate these highs and lows and find the sizes and keep subtracting as the market goes, but I like to use these boxes because they're really quick way of analyzing. Just make sure you draw it accurately. So we have this cycle going up, and we're waiting for the market to drop down to this bottom to buy, and we have this bigger cycle going on. Meanwhile, we have this. It's a little bit small to trade. I only trade. Actually, it might be enough. I use the average true range to measure the size of corrections. On daily bar charts, I wait for at least 2 times the volatility, 2 times the average true range before I'll start buying. I mean, before I start using a rhythm. These really small rhythms are for intraday. You know, it's not something you should use on daily bar charts. That's more for intraday trading. So this, I'm not sure if it's 2 ATRs. It might be. It's close. So just let us look at it. So now you have 3 rhythms going on at the same time. Like I said, I like to use different color boxes. So here's this rhythm going to complete here, buy signal. We have this rhythm here, which we measured earlier, came really close to it. And that was a buy signal. And then we have the biggest rhythm, I mean the bigger rhythm, not the biggest, giving us a buy signal here. So we have that. And then we have this correction wave, match this correction wave. Now, like I said earlier, each trend wave, each cycle, each rhythm has its own structure. So you have trend wave 1, correction 1, trend wave 1, trend wave 2 of this entire cycle, but correction wave 2, trend wave 2 of this cycle here. You see how cycles work within each other, or rhythms work from inside each other? This one completed, and then it dropped down to this rhythm here, match that. So now, as this third trend wave develops, it's going to have its own trend wave 1, correction 1, trend wave 2, correction 2, trend wave 3, correction 3, and trend wave 4. So this rhythm here would be measured, and you would keep subtracting the same amount of correction from this here, and you would enter right down here. I'm not sure if we should stop and take questions at this time, or maybe I should just keep explaining how the Dillion Wave Theory works. So I'm going to go to another chart here. We got quite a few charts to analyze today. And we're going to move down to here. This is the E-mini S&P. And we're going to go and look at the weekly charts on that. So it's the same thing. We're looking at this. Let's see. Now the downtrend is the same thing. Okay. This is the uptrend that lasted for many years. This is the crash of 2008. And at some point here, when the market went below these lows, I figured it's a downtrend. And I measured from this low to high. And as the market made lows, I moved my right there. Let's see here. Let's expand that. You can see a really big quick rally and a quick drop. So the nice thing about the Dillion Wave Theory is once you identify a rhythm, it's very highly that it's going to repeat. Even if it doesn't go all the way back down, at least it's going to come to it and bounce off of it a little bit. You know, enough to move your stop down in this case, since you're shorting here. So knowing that, you don't start looking to buy around here. Instead, you wait for the third trend wave to complete, and then you start looking for a potential buy signal. However, what I just said is not a good idea. You should never trade against the trend unless you have a Dillion Wave support price to go off of, because trading against the trend is the sure way to lose money. So what you would do is you identify this cycle, go short here. Like I said, the third time the market repeats the rhythm, I usually wait for a daily bar chart price pattern to go short, and then eventually the market reverses its trend, and we already analyzed the uptrend. So here, wait for 2 corrections to be completed before thinking about buying. So if you thought the stock market was going to bottom at some point, you should do it after the 2 rhythm cycle is completed. So this is the E-mini S&P. It's the same pattern. You keep moving the box up until you have your support price. Okay, so here it is. Once, twice. Now, don't use Dillion Wave Theory to go against trend. So here you have a rhythm, and then market dropped, and then here you have another rhythm. Now, if you went long here, this would give you a profit target, but don't go short against the trend. Yeah, Dillion Wave Theory is very accurate going with the overall trend. It's not that accurate if you're trying to go against the trend. There are some exceptions which I'll teach you during this webinar. So this would be a profit target for me. If I'm long here, that would be my long-term profit target. All right, now we're going to go to Apple. Let's see what Apple is doing. So here we had this big drop, right? And what does this big drop relate to? It relates to this big correction here on a weekly. So you had this huge uptrend. Apple stock drops. We're going to go and make a rectangle for a quick measurement. If you want to be super precise, like I said, you calculate the high, you subtract the low, you get the exact size of the correction, and you keep subtracting as the market makes new highs. All right. So we're going to move this box. Each time the market makes a new high, you're going to move it up, which also means if you're using weekly charts or you're looking at big corrections, you only need to do this once a week. Of course, if you're a day trader, then you have to constantly follow the markets. All right. So we have the Dillion Wave support price right here. Again, this is close enough to get in. I never wait for exact entry because the best trades are going to fall a little short and then take off. So Apple tells you that it's not in a downtrend because this is correction wave 1, this is correction wave 2. So I'm going to try to buy it here on our analysis membership subscription service. We gave a buy signal. We had a buy signal here near the bottoms because once the market took off, I wanted to see this market come below this low to buy it. It didn't. However, it gave us a triple bottom here. 1 bottom, 2 bottom, 3 bottom. So the alternative was this market is close enough to the support price. I'm going to buy this on a breakout. So we bought this on a breakout right here. So you can see this big the second trend wave had its own smaller correction cycles. This one is right off of this. Right here. And then it repeated itself one more time here. Now this is too small. I wouldn't trade this. This is not 2 ATRs. It has to be at least 2 ATRs. This is like 1 ATR, maybe 1.5 ATR. So this white cycle I would not use. Okay, this green cycle, it seems like it seems like that's not 2 ATRs either. I don't think so. This is like 1 ATR. This is not 2 ATRs. Then you have this bigger cycle here, the yellow cycle, because the reason you know this is a new rhythm, it's bigger than any of these past corrections. Let me see, yeah. So you end up moving this here to the highs, and you can see the market came and hit the bottom and rallied. Now, if you're a swing trader, you took 1 or 1.5 ATR profit. If you're a day trader, you should at least go for maybe 70% of 1 ATR to 1 ATR profit target. And if you are a position trader, when the market rallied, you move your stop to break even. So if the market comes back down, you're out and you're waiting for the next support price, and the next support price is down here. So that's where you would be doing your buying. It's kind of complicated but simple. It's like anything else. The more you practice, the more ideas you will have what and how this works. And it's really worthwhile learning it thoroughly, because nothing else out there will give you objective classification of rhythms based on similar size and give you support prices at the same time and be this accurate. So now we're going to go to Google, see what Google is doing. All right, so Google weekly charts, yes, it is. So we have a beginning of uptrend here. So we would need to grab a rectangle. Now, like I said, this is not a 100% accurate system, but it's accurate enough that it's tradable, it's very profitable. I have probably done, I don't know how many thousands of coding and research on, basically there's 2 ways to enter the markets. You either enter on a correction or you enter on a momentum. The momentum could be a breakout, or it could be a big bar up or a very big bar up, or it could be an indicator coming down and turning back up. So you have really 2 ways to enter. Predictive entry, like Fibonacci ratios, Gann lines, Dillion Wave Theory, or you enter on a momentum. And all the tests show Dillion Wave Theory is more profitable than anything else that I have seen or I've been able to create since 1980. So here's a big cycle. We wait for a new high. Once we get the new high, we move this up. This cycle here did not complete. Well, it completed, but it didn't give us a chance to get in. It's not low enough. I get in a little above, but not this much above, because then your stop has to be too big. So we have this cycle. Then we're going to need Now I haven't analyzed Google, so we're analyzing it as we go. I haven't checked it out. So here's a new cycle. Let's make that a yellow box. Like I said, I like to color code my cycles so I have a clear picture when I look back at the history. And bottom of this box or near it is going to be a buy signal. And again, we don't get a buy signal from this either. Now this is a new cycle here. So we have this here, which came close enough to buy. So we would buy it. And then we have this smaller rhythm right here, which gave us a buy signal, probably right here. Let's check that out. This is probably 2 ATRs at least. And came close enough to buy here. And then the cycle keep going. Here, again, when you buy at this low here, it's going to be accurate. This is the second correction, and we get the bounce and makes a new high, and that cycle is completed. So technically, you shouldn't use this again because the market made a new high. But if you're confident that cycle is going to hold, here you have your double bottom and a breakout, and I might have traded that and put my stop right below these support prices. So recently, this probably here, let me squeeze this in a little bit. This big cycle here, probably this is what this one is right there. So that repeated. Now this is a bigger cycle than this one, I think. I think this is 20% bigger. So you would take another rectangle and measure that, and that would become your new cycle. So there it is, right there. Here was another buy signal based on this rhythm here. So currently, what is this market doing? Well, we had, I'm going to just duplicate this 1 second. So we have this bigger rhythm here, which match over here, and this is probably the third rhythm. Yeah, you can see it. It dropped down to here almost twice. Like came down here and came down here again. Like you would buy it here, I would be cautious buying it here because it's the fourth rhythm. This is, let me go over these really quick. So you have this big correction matched by this big correction. Notice how this big correction took months, and here it took only weeks and then rallied. So then you have your third, makes a new high, and you have your fourth. So I would be cautious at buying that on a fourth. I would think, my thinking is when you have this many corrections in a rhythm, you're more likely to get a bigger correction. And if we look at monthly charts, maybe we'll get an idea what that correction should look like. Let's look at monthly charts to see if we see anything in the background. Yeah, you see this big correction here? Look, these corrections we already have right here. This correction matched by this correction, and this bigger one also matched here again. Now you have this big cycle here. You see the benefit of looking at monthly and weekly charts? It gives you an idea what the markets might do in the future. So eventually, we're going to see a correction that is this big here. So if this market wasn't to hold and the market was to turn around, Google was to turn around and start dropping, I would almost wait until it drops to 570 and then look for a buy and not think it's a trend reversal at that point. It's a downtrend from here to here, but it's a buy signal based on Dillion Wave Theory down here. So these next few charts are very interesting because I was looking to see what stock markets I should be looking at, and one popular website said these were the some of the stocks that George Soros was trading. So I thought, okay, let me look. Now here we have a downtrend, so there's nothing to buy. This big correction has been matched over here, so there's nothing to match. So we need to wait for an uptrend, correction, another uptrend, another correction before we buy. So here there's nothing to analyze. Same thing, we have this big drop. We need to get a new uptrend. Once the market makes a new high, we can come back and measure this correction right here. When the market makes a new high here, we'll start moving this box up. And this is our support price. When the market drops down to the support price, we'll buy. There's another stock that George Soros, well, doesn't have enough history. So we'll go to eBay. That was PayPal, by the way. So what do we have here? We have downtrend, uptrend established. We're going to take this support price and move it up. And here it came close enough to give us a buy signal. Eventually, we're waiting for a bigger correction. Let's see if this is a bigger cycle. No, it's the same cycle. Here it is a little short of the support price. Here it went a little over the support price. Like I said, it's not always exact, it's similar. And then we end up having a much bigger correction. So it's a new cycle. And when the market makes a new high, we move it up. And then you can see market drop sharply to it and rallied. So we had a buy signal here. That cycle is completed. Now the market has a bigger rhythm. This is a bigger rhythm now. You can see it if we move to the high where the correction began. It's 20% bigger than this. Therefore, this is a new cycle. It's rhythm number one. This is the first rhythm. It's bigger than any of the previous corrections from the bottom of this uptrend. So this is a new rhythm. Once the market makes a new high, we can measure this new rhythm and start moving our boxes to find support price. This is Facebook. Now Facebook, let's see, let's look at the, we're on the monthly charts here. All right. So I have to look at weekly charts to see what happened in the past. Okay. So we had this rhythm here. You know, the uptrend begins, and we have this correction, and we have a matching here. So we have a buy signal. We write this, and as the market makes a new high, we measure the new rhythm because it's bigger than any of the previous corrections. And then we should match that sometime in the future. As market makes new highs, we move it. This got stopped out probably, unless you are a money manager and using white stops. Their market came and fell right through it, and we probably got stopped out. And then we have a new rhythm here, and that rhythm hasn't been matched yet. And then we have this new rhythm. This correction is 20% smaller than this correction here. Therefore, it's a new rhythm, which we're going to measure. And when the market makes new highs, we're going to move both up. And then it matched this one and rallied. So it seems like time went by really fast. I'm going to switch to some currency trading here because there could be many currency traders. And I'm going to switch to daily bar charts. All right, so we have downtrend here. Here I have identified several rhythms. This is a downtrend. So this is correction wave 1. And then market goes down, This is part of the same rhythm here, even though I marked it with yellow box here, because this and this correction are within 20% of each other, so it's the same rhythm. And then the market makes new low. All right, so we might have been able to enter this if we put our entry price low enough, but I'm identifying this to be one cycle here, so this yellow and this. However, they're too close to each other, so I would be using the blue cycle. So my rule of thumb is when I have two cycles that are very close to each other, I always use the bigger rhythm. Always use the bigger rhythm when they're near each other like this. Okay. Then you end up having the smaller rhythm inside this bigger rhythm, this bigger rhythm here, and then you have a smaller rhythm inside it. So I'm going to take this blue box, measure this rhythm, and here it is. It hit here. If you use white stops, you're going to make a profit. If you use 1 ATR stop, actually this is less than 1 ATR, so I think you would be okay because the volatility is quite high. Even if you got in here and used 1 ATR stop, I think you would have been okay. Now, let me explain. My favorite way of trading is currencies is to get in very close to the resistance price, use 1 ATR stop, use 1 ATR profit target. Like that, I don't have to monitor the market day in, day out. I just put my entry short, my stop, my profit target, I'm done. If you're using these Dillion Wave support and resistance prices for position trading, you have to monitor the market, because once it makes the, once it goes quite a bit below, about 1.5 ATR below the support price, I move my stop to break even. That gives you the highest accuracy, because if market is going to move fast, it's going to move fast. Here we have this bigger correction. You can see this correction is bigger than any of the previous corrections here. So this is your rhythm one, a new cycle, new rhythm. Market makes a new low, and it comes close enough to go short. Comes second time, okay. Third time, never get in. I mean, third time it gets low accuracy. You don't want to get in the third time the market comes to the same resistance price. However, you did make a quick profit from here. These are daily bar charts. So then we have market turning up, and we have to measure now the support prices. So you got this rhythm, which was match here. The problem is we're still in a downtrend, so you don't want to trade this. So you want to wait for the trend to reverse to the uptrend, and then you can use this. Now this is a key, and then you can start using it. So here again, it went. You can see sometimes it goes below the support price and then rallies back up. So if you're a position trader, you move your stop to break even. You don't lose anything. If you're a swing trader, day trader, swing trader, you make money here. Now this correction here is the biggest rhythm. This is where the uptrend began, right down here. Sometimes I wonder if you're able to follow my cursor. Let me do a drawing tool here. This is where the uptrend began, and this is your biggest correction. When the market makes a new high, keep measuring, keep using this correction for a potential buy signal. Very likely you're going to have another correction, smaller rhythm inside it, and you're going to use that matching these two. Let's see what Euro Audi has to do. All right, so obviously this is referring to a weekly chart here. Sure enough, so what we got is we got this big correction here. This is the uptrend, and this weekly charts. So the market might be on a daily chart on a downtrend, but you might think that the downtrend might end when the market comes down here, because we have a really big correction here. So it gives you an idea. If the market drops down to here, maybe you'll have a chance to buy. Since this is a really big correction, you're going to expect a really big rally. So you can benefit from it in that way. Okay, Euro NZD. Here is a downtrend. You have a bigger cycle here. And inside this big downtrend wave, you have a smaller cycle. This is the first rhythm. This is where you short. This is the third time it comes to it. In other words, first correction, second correction, third correction. Like I said, I don't get in on the thirds. I always get in on the second ones. And then the market reversed to the uptrend. You had, let's see, daily bar charts. I like that the MetaStock, when you switch from daily to monthly charts, it keeps the drawing tools on the charts, which helps. So we're still in an uptrend, even though this is a really big correction. This is still an uptrend, and you have this cycle here, which matched down here, and then it completed. Now it's in a bigger rhythm here. If market goes up, we're going to take this box here, expand it, and as market goes up, we're going to move it. Eventually, it should drop down to it. Let's do a few more. This is downtrend. There's nothing to look at. Let's look at the monthly charts. Yeah, there is no. This seems like it entered into a new downtrend, or it's correction number one. And then if the market resumes its uptrend, we'll be able to use it. Canadian dollar. Okay, it looks like I got a lot of notations there. Let's go to daily bars. And maybe. So here the market is in a downtrend. It ends its downtrend and potentially begins an uptrend. At some point, you figure the market is in an uptrend, so you start measuring the rhythms. So this is a bigger correction than these two by 20%. So this is a new rhythm, and you keep moving your support box up. When market comes down to it, rallies, comes a second time, rallies again. The third time we don't get in, and it's a bigger correction, so it's a new rhythm. So we're gonna do. Now there was this white rhythm here, which we didn't measure. We want to go back. So you have this bigger rhythm and the smaller rhythm at the same time. The rule of thumb, the small rhythms match first, right there. Even though it's only, wait, let's get this to the top of the, make it accurate. So you can see how close it came and rallied. So for swing traders, day traders, that was a good profit. For position traders, break even. And then this is your next entry. And then you have your bigger correction. So now we're going to measure that. On our website, if I can mention that, let me see. On our website, we have blog, which you can use. It's free market analysis. So basically, the reason I'm mentioning is you're not sure what to do with this system. You can keep looking at our free market analysis and keep getting an idea of how to use this tool. So this correction didn't come low enough to get in. We might be able to, I keep moving the wrong box. There we go. Now it matched. So we have a buy signal here. Now this correction from here to here, it's a bigger cycle. So we're going to need to measure that. And see if we eventually match this bigger cycle. We matched it right here. Market came down to it, rallied, came second time, made a double bottom. I would buy a breakout, but I would also move my stop down here somewhere really quick, or maybe even when the market rallies here, maybe would even break even, because it came to support price, came to support price, came to support price, and then you're buying. It should go up if it's going to go up. I mean, usually it goes on the first bounce, and here you're on a third bounce. You're buying a double bottom formation. I would move my stop up really quick here. And then the market is in this huge correction. I don't know if we have anything that matched this from the past. Let's look at the monthly charts. Well, look, I'm going to go to weekly charts and contract this. Now you have this big cycle here, which you would keep moving up. Okay. I don't know if I'm going to be able to move that tool, but this seems to be this. We didn't get a chance to get in unless, let me see here. Okay, there's the top right there. It came close, but I'm not sure it came close enough to get in. But you can see when you look all the way back, there was a big rhythm that hadn't been matched, and based on that, you drew the square and you had your support price here. Market came very close to it and rallied. So what else? Gold chart. Let's do a gold chart, the last one. So we had gold chart come all the way down there. We had recently a triple bottom, which gave us a buy signal here on a breakout. And this is not Dillion Wave Theory. This is a different method of analysis that I use. So it gave us a buy signal. Now I'm thinking, where is the profit target? Unless you think the market has back in bull market and you want to ride it all the way out based on this buy signal, you have three rhythms to choose from. This rhythm here, this rhythm here. Notice that how it matched. Remember earlier I said when they have two rhythms that are really close to each other, I use the higher one. I use the bigger one because that tends to be more accurate. Also, it's a better entry price. Now you have your third rhythm, which is also really close to each other. So if I was long here, then my exit would have been here. I might even have shorted it. And then the next target looks like it's going to try to go here. I definitely would go short here and see if the market comes back down. Now, once the market goes above this yellow, if this resistance price doesn't hold, I would be for sure that the market has reversed and it's in an uptrend. So then I would start looking for corrections, rally, correction to buy. Thanks for attending. I appreciate your time, your valuable time. I'll turn it back over to Hunter for the closing comments.
Thank you so much. Wonderful, a wonderful presentation. You know, like I said before, you know, we have you know, a lot of faith that this system is going to be talked quite a bit about. Michael, I don't know if you have your contact information that you want to put on the screen or your website. You guys can always contact us at MetaStock at www.metastock.com/sales chat. Whoever you speak to, just tell them about the webinar you saw. You can also go to the Dillion Wave Theory website, and I can have Michael actually put that in the chat box as to what that website is. If you guys have any questions, feel free to contact either one of us. We're going to go ahead and wrap up here. Thank you so much for attending this webinar this evening, and as always, happy trading.